When you invest in global ETFs, you're not just betting on the stock market, you're also betting on different currencies. But does this really matter? And as a UK investor, should we be hedging against this risk? If you want to buy a typical S&P 500 ETF as a UK investor, your pounds get converted into US dollars in order to buy those US stocks. When you want to sell it, the reverse then happens and it gets converted back. So depending on how the pound and the dollar perform, that's going to change the return you get on that fund. That's where currency hedging comes in. And this year is a great example because the pound has appreciated against the dollar. It's up around 8% so far year to date. So although the S&P 500 has hit multiple all-time highs this year, UK investors are looking at their portfolios and wondering why they haven't got the same return as US investors. Let me show you what that looks like. These two funds are both from iShares covering the S&P 500. The orange line is your typical S&P 500 ETF denominated in the US dollar. The blue line is exactly the same fund, but it's GBP hedged, which means it effectively ignores any appreciation of the pound so far this year. And that's reflected in the performance, with the typical ETF up around 12% compared to the hedge version up over 18%. But of course, this is not always going to be the case. And we've also got to look out for the different costs in hedged ETFs. It will depend on the provider, and here I've highlighted Invesco and iShares. Invesco charges the same fee for its typical S&P 500 ETF and its hedge version, both at 0.05%. However, look at the iShares funds. Its typical ETF is priced at 0.07%. However, the hedge version is priced at 0.2%. So when might you want to use a hedge version of an ETF such as the S&P 500? I think for most investors, they're more likely to pick a hedge version when they have slightly shorter term investments. If you have a really long time horizon, that fluctuation in currency is likely to even out over that long period of time. You're letting the market naturally decide where that appreciation is going to go. So although the pound has appreciated against the dollar this year, it might even out over a longer time period. However, if you've got a slightly shorter time horizon, say 2 or 3 years, then that FX risk could play a bigger role in the performance of your fund. And that's where you may want to look at a hedge version. And that's because investing over that shorter time frame does increase your risk slightly in terms of market volatility. Over a long period of time, you can ride out volatility and be confident you're going to get a positive return. But if you're investing for the short term, it's likely because you've got a set date where you know you're going to need the money. So if you invest into an ETF that is denominated in a different currency, then obviously not only are you taking on the market volatility of the stocks, but also the currency volatility as well. If you do want to take a slightly more active approach, you could have a look at where the currency is in terms of its long-term trend. So if we look at the pound versus the dollar over a long time period, we can generally see over the last 10 years, it's stayed roughly within these two lines. The top end at 142 and the bottom end around 1.2. Before then, in 2014, it did start to come down. This was following Brexit. But from that period, so the last roughly 10 years, it's roughly stayed within these two lines. There has been times that it's pierced below it ever so briefly. This period here in 2022 was the mini budget where the pound crashed, but it quickly recovered. So right now, we're sitting around 131. 132. And you can see from the beginning of the year when it was sitting around 121, it has appreciated against the dollar. But now we're sitting somewhat in the middle of this very long-term trend in terms of a resistance and a support line. So looking at that from a perspective of a long-term investor, there isn't really a strong probability of where the FX risk is going to be. If the rate was sitting up here around 140, then you could make the argument that because this 142 is such a strong resistance, it's likely to bounce off that level, and the US dollar would then actually start to appreciate against the pound. And actually, you'd be better holding the typical version of the S&P 500. And likewise, if the rate was sitting down here at 120, historically, this has acted as a very strong support level. So then you can make the rough assumption that the pound could bounce off this level and it could appreciate against the dollar. And in that case, like we've seen this year, you'd be better off holding a hedge version. But that is taking quite an active approach. And I think going down the hedge route is quite a niche scenario that would actually be beneficial to most investors. The other case would be, say you have quite a few ETFs that are part of a portfolio and most of them are denominated in US dollar, then you may want to look at some hedge versions of those ETFs just to slightly reduce your risk to that one currency. But again, this is quite a niche scenario. For most people, that FX risk is going to balance out over time, especially if you're investing regularly. Let me know your thoughts on hedge products down below in the comments. I have recently started a free Investing Insights newsletter. To get access, you just need to subscribe using the top link in the description below. It will always be free, and if I annoy you too much, you can always unsubscribe anytime. Hope you found that useful. Thanks for watching, and I'll catch you in the next one.